Hi, I'm David Stein of Money for the Rest of Us, and today I'm discussing how to not run out of money in retirement. One of the most daunting challenges facing new retirees is determining how much they can spend each year in retirement without depleting their retirement savings. If you run out of money in retirement, that's called retirement ruin. And it's not an easy task because there are two large unknowns. How long will you live as a retiree? And what rate of return can you earn on your investment portfolio? That second unknown of investment return is especially challenging because the issue is not so much the average annual return on your portfolio, but the sequence of those returns. In other words, a retiree that has a negative return in the first decade of retirement, but then has positive returns in subsequent years, has a higher probability of retirement ruin than a retiree who has positive returns in the first decade of retirement, followed by some negative returns later on. A study by Michael Kitces and Wade Faw, highlighted in the American Association of Individual Investors Journal, found that retirees have a higher probability of making their retirement savings last by starting with a lower allocation to stocks in the early years of retirement, and then increasing the equity allocation as they age. This is counterintuitive to traditional financial advice to reduce stock exposure as one proceeds through retirement. But the advice is sound because the sequence of returns risk that I mentioned earlier. A lower equity allocation in the early years of retirement, when balances are large and life expectancies are long, helps to avoid catastrophic portfolio losses. Later in retirement, when the balances are smaller and life expectancies are shorter, is a time when higher stock exposure makes more sense. The advantage of this approach is if market returns are poor during the first half of retirement, the retiree is able to avoid much of that portfolio pain while at the same time systematically increasing their allocation to stocks at more favorable entry points when valuations are lower. This is known as dollar cost averaging. There are other ways to mitigate the uncertainty of not knowing how long you will live in retirement. One avenue retirees can pursue to increase the impact of their savings is to convert a portion into what is known as a single premium immediate annuity, or SPIA for short. At its simplest, an immediate annuity is a contract with an insurance company. A retiree gives the insurance company a lump sum, the premium, and the insurance company promises to pay a specific periodic dollar amount, usually monthly, for the rest of the retiree's life, and depending on the contract, the lifetime of the surviving spouse. Annuities have been around since ancient Rome, when contracts known as annua promised individuals a stream of payments for a fixed term, sometimes for life, in exchange for an upfront payment. Single premium life annuities were available in the Middle Ages and have been available in the United States for over 200 years. So SPIAs are priced with the present value of the annuity payments received by the insurance company approximately equals the premium paid upfront by the annuitant for those that live to the median expected age. What that means is if you're age 65 and buy a SPIA and then live 19 years until you're 84, which is the median life expectancy for 65-year-olds, then the value in today's dollars of the annuity payments you received would approximately equal the lump sum premium you paid. Of course, if you die before your 84th birthday, you wouldn't get your money's worth. The present value of the annuity payments you would have received will be significantly less than the premium you paid. But conversely, the present value of the annuity payments will be much greater than the premium paid for those 65-year-olds who live well beyond their 84th birthday. And of course, most purchasers who buy an annuity, they do so to mitigate longevity risk. They think they're going to live well beyond their 84th birthday and come out ahead on the single premium immediate annuity. Those who live longer partially benefit from the premiums paid by others who didn't live as long. This is no different from other types of insurance. The payout insurance companies make to policyholders who suffer a house fire comes partly from the premiums of policyholders whose homes didn't burn down. So here are a few things to consider when buying a single premium immediate annuity. The older you are when you buy a SPIA, the higher the monthly annuity benefit because your life expectancy is shorter. Another thing is the higher interest rates are, the higher the monthly annuity benefit because insurance companies can earn more investing the premiums and thus can afford to make higher benefit payments. Another thing to consider is most SPIAs are not indexed to inflation, so the purchasing power of the monthly premium benefit decreases over time. That's why you probably don't want to put all of your money in a single premium immediate annuity when it keeps some out to be able to adjust for inflation over time. Finally, while it's important to purchase an annuity from a highly rated insurance company, the risk of issuer default is low. Insurance companies are regulated by individual states who are responsible for making sure the insurance company has sufficient reserves to cover annuity payments. In a worst-case scenario, if the insurer defaults on the annuity payments, there are state insurance and guarantee pools that will step in and continue to make the annuity payments. Hey, if you like this video, go ahead and subscribe to my channel below. And if you have any questions on single premium immediate annuities, just leave them in the comments.